Overview: the 2025 Fiscal Transformation. The 2025 fiscal year served as the primary catalyst for the current valuation of Hudbay Minerals. Hudbay reported record annual revenue of $2.2 billion and adjusted EBITDA exceeding $1.1 billion. The company generated $388 million in free cash flow for the year, with a significant $228 million produced in the fourth quarter alone. This cash flow generation enabled a deleveraging of the balance sheet, reducing net debt to just $20 million on an adjusted basis following the closing of the Copper World joint venture in early 2026. The transition from 2025 to 2026 marks the beginning of a generational reinvestment phase. With the balance sheet targets achieved ahead of schedule, the focus has shifted towards the sanctioning of the Copper World project in Arizona and the integration of the Cactus project following the acquisition of Arizona Sonoran Copper Company.
Bull case analysis. The bull case for Hudbay Minerals is predicated on the company's ability to execute a multi-jurisdictional expansion that effectively doubles its copper production profile while maintaining one of the lowest cost structures in the industry through gold byproduct credits. Financial flexibility and the strategic partnership model. The most immediate pillar of the bull case is the fundamental strengthening of the company's financial position. For years, Hudbay was characterized by higher-than-average leverage as it invested in the Constancia and Snow Lake assets. However, the 2025 results and early 2026 strategic moves have recast the company as a leader in capital allocation efficiency. In January 2026, Hudbay closed a $600 million joint venture JV transaction with Mitsubishi Corporation for a 30% interest in the Copper World project. This transaction provided $420 million in immediate cash, with an additional $180 million due within 18 months, effectively funding the majority of the remaining feasibility and pre-sanctioning costs. By bringing in Mitsubishi as a partner, Hudbay has not only validated the project's economics, implying an internal rate of return of approximately 90% for Hudbay's remaining interest, but has also secured a partner that will fund its 30% pro rata share of all future construction capital. This significantly reduces the equity burden on Hudbay and minimizes the risk of dilutive share issuances. Furthermore, S&P Global's upgrade of Hudbay to BB- in February 2026 reflects the success of the company's debt reduction strategy, which included the repurchase and retirement of $185 million in senior unsecured notes in 2025 and the full repayment of $472.5 million in 4.50% senior notes due in 2026. The introduction of a quarterly dividend of C-cents 1 per share, a 100% annual increase, signals management's confidence in sustained free cash flow generation even as it enters a major construction cycle. This transition from a debt-heavy growth story to a balanced yield-paying producer is a classic re-rating catalyst that often attracts a more stable, long-term institutional shareholder base.
The creation of a North American copper powerhouse, Arizona District Synergies. Hudbay is currently executing a strategy of district-scale consolidation in Arizona that is largely unmatched by its peers. The foundational asset is the Copper World project, which is unique in the United States for being situated primarily on private land. This land status allows for a state-led permitting process, avoiding the multi-year delays often associated with Federal National Environmental Policy Act (NEPA) reviews. With the receipt of the air quality permit in January 2025, the final major permit required for Phase 1, Copper World is now considered one of the best fully permitted copper development projects in the Americas. The bull case was significantly enhanced in March 2026 by the definitive agreement to acquire Arizona Sonoran Copper Company, ASCU, for approximately $1.48 billion in equity value. This acquisition consolidates the Cactus project, a past-producing brownfield site, into Hudbay's Southern Arizona hub. The logic of this consolidation is anchored in several high-value synergies.
Operational integration. Hudbay intends to redeploy the trained construction and operational teams from Copper World to Cactus once the former is commissioned, ensuring a seamless transfer of skilled labor and regional expertise. Permitting and land. Cactus is also situated on private land, benefiting from the same streamlined state-led permitting pathway as Copper World. Production scale. The integration of Cactus provides a clear pathway for Hudbay to grow its annual copper production from approximately 125,000 tons today to more than 250,000 tons by 2030, with the potential to reach 350,000 tons as the district matures. Resource quality. The Cactus project features a reserve grade of 0.52% CUT, which is significantly higher than major operating U.S. mines like Morenzi, 0.23%, and Baghdad, 0.35%, positioning Hudbay as a low-cost leader in the domestic U.S. market. By creating the third-largest copper district in North America, Hudbay is capitalizing on the Made in America supply chain narrative. Copper cathode produced at these facilities will be sold directly to domestic U.S. customers, helping to meet the critical mineral demands of the domestic manufacturing and energy sectors.
Operational stability and margin expansion through byproduct credits. A core advantage of the Hudbay portfolio is its high exposure to gold and other precious metals, which serves as a natural hedge and a significant margin expander. In 2025, gold revenue represented 38% of the company's total revenue, reaching 41% in the fourth quarter. This precious metal content allowed Hudbay to achieve a consolidated cash cost of negative $0.22 per pound of copper for the full year 2025, as byproduct credits more than offset the direct costs of copper mining. The operational stability is further underpinned by recent mine life extensions announced in March 2026. Through successful exploration and optimization, Hudbay has extended the expected mine lives across its portfolio.
Constancia, Peru, extended to 2040, with mill throughput expected to increase to more than 90,000 tons per day in the second half of 2026 following the installation of pebble crushers. Snow Lake, Manitoba, extended to 2041, maintaining its status as a premier gold production hub. Copper Mountain, British Columbia, extended to 2045, with copper production expected to nearly double by 2027-2028 as the mill reaches its permitted capacity of 50,000 tons per day and accesses higher-grade ore. This longevity ensures that Hudbay will remain a significant producer well into the next 2 decades, providing long-term visibility for cash flow and earnings. The company's 11-year track record of meeting copper guidance is a testament to its technical competency and operational resilience in the face of varying geological and external challenges.
Macroeconomic tailwinds. The broader macroeconomic environment for copper is arguably the strongest it has been in several decades. Analysts describe a copper paradox, where despite high prices, global inventories remain near historic lows, and new supply is inhibited by regulatory and financial barriers. Global copper demand is projected to grow from 28 million tons in 2025 to 42 million tons by 2040, driven largely by 3 primary sectors: electrification, renewable energy, and data centers. Hudbay's 3-year production outlook, which projects a 24% increase in copper production by 2028, is perfectly timed to coincide with a projected refined copper shortfall of roughly 330,000 metric tons in 2026. As a mid-tier producer with significant unhedged exposure, Hudbay is a primary vehicle for investors to capture the upside of record-high copper prices, which touched an intraday peak of $6.11 per pound in early 2026.
Bear case analysis. While the bull case for Hudbay is compelling, the company faces significant operational, jurisdictional, and market-based risks that could impair its ability to realize the full value of its assets. Persistent jurisdictional and social unrest in Peru. The Constancia mine in Peru is a foundational asset for Hudbay, yet it is located in the Southern Mining Corridor, a region prone to chronic social instability and political fragmentation. In September 2025, the facility was forced to shut down for approximately 2 weeks due to blockades by local community groups. These disruptions are largely outside the company's direct control. The Southern Mining Corridor frequently sees blockades that impact multiple major operations, including MMG's Las Bambas and Glencore's Antapaque. In late 2025, ocean swells and transportation blockades led to the deferral of a 20,000-ton copper concentrate shipment, illustrating how logistics can impact quarterly financial results even when the mine itself is performing well. Furthermore, the transition away from the high-grade Pampacancha deposit back to the main Constancia pit in 2026 means the operation will have less margin for error, as it relies on higher throughput to maintain production levels amid declining grades. Persistent social unrest could prevent the company from achieving the throughput necessary to offset these grade declines, leading to production misses.
Execution and inflationary risks of major development projects.
Hudbay is currently advancing several of the largest and most capital-intensive projects in its history. The first phase of Copper World is estimated to cost approximately $1.5 billion, but industry analysts have cautioned that actual capital costs could be significantly higher due to the inflationary pressures that have plagued the mining sector over the last 3 years. S&P Global Ratings has assumed a spending level closer to $2 billion on a 100% basis for the Copper World construction period. The development of mega projects involves inherent execution risks, including potential delays in the delivery of long lead items, labor shortages for skilled mining construction, and technical challenges during the commissioning of complex processing facilities. While the Mitsubishi JV reduces the funding requirement, Hudbay remains the project operator and bears the primary technical responsibility. Any significant cost overruns or schedule delays could strain the company's newly strengthened balance sheet and force a reversal of its deleveraging trend. Additionally, the integration of the Cactus project adds another layer of complexity to management's execution mandate, as they must simultaneously manage construction at Copper World and detailed engineering at Cactus.
Regulatory and legal challenges in Arizona. Despite the advantages of private land and state-level permitting, Hudbay's Arizona projects face persistent opposition from local governments and environmental groups. In January 2026, the Pima County Board of Supervisors passed a resolution formally opposing the Copper World project, citing potential long-term risks to water resources and air quality. While the company has already secured its major permits, local opposition can manifest as protracted legal battles and administrative appeals that create uncertainty for investors. Environmental organizations like Save the Scenic Santa Ritas have spent decades opposing mining in the region and continue to challenge every step of the development process. One current focal point is the auction of a 160-acre state-owned parcel intended for tailing stumps. Opponents are urging the governor to block the sale, arguing it would create a toxic waste dump in a sensitive mountain range. In the broader U.S. context, mining projects often face connected action legal theories, where opponents argue that state-level activities are inextricably linked to federal land impacts, thereby requiring full federal oversight under NEPA. If a court were to accept such an argument, the permitting timeline for Copper World could be set back by several years, fundamentally altering the company's growth trajectory.
Commodity price sensitivity and market volatility. As a mid-tier producer, Hudbay's valuation is highly sensitive to fluctuations in copper and gold prices. While the long-term outlook for copper is bullish, short-term market dynamics can be volatile. Goldman Sachs recently trimmed its 2026 copper price forecast to an average of $12,650 per ton, citing softer demand expectations amid weaker global economic growth. The bank also warned that prices could drift down toward a fair value of $11,100 if economic conditions deteriorate further. In 2025, more than half of the company's income was derived from copper, making it vulnerable to any sustained decline in industrial activity that would mute metal demand. Furthermore, the company's cost structure is susceptible to rising energy prices and environmental regulations, which could increase the cash cost of production and squeeze margins. If the global economy enters a recession and copper prices revert to their historical mean, Hudbay could find itself with a large capital expenditure commitment just as its operating cash flow begins to decline, creating a potential liquidity squeeze. The high level of sustaining capital in 2026, projected at $435 million, is a double-edged sword. While it represents necessary investment in the longevity of the assets, it also reduces the amount of free cash flow available for debt reduction or dividends during the transition period.
Deep dive into the Arizona Sonoran acquisition, ASCU. The acquisition of Arizona Sonoran Copper Company is perhaps the most significant strategic move Hudbay has made since the Copper Mountain merger. To understand the long-term value, one must examine the mechanics of the transaction and the specific geological profile of the Cactus project. Under the terms of the arrangement, Hudbay will acquire all outstanding shares of ASCU it does not already own, with ASCU shareholders receiving 0.242 of a Hudbay share for each share held. This implies a value of C9.35 per ASCU share, a 30% premium to the market price at the time of the announcement. Upon completion, existing Hudbay and ASCU shareholders will own approximately 89% and 11% of the combined company, respectively. The strategic logic is built on the integrated district model. a standalone copper operation typically carries a capital cost of $400 to $600 million, with processing costs of $8 to $12 per ton.
However, an integrated district can reduce these processing costs by 30–40% through shared facilities and scale. Hudbay intends to update the Cactus pre-feasibility study post-closing to reflect its own technical and project design assumptions, seeking further efficiencies beyond the current estimated cash costs of $1.34 per pound. The Cactus project is also remarkably de-risked from an infrastructure perspective. It is a past-producing brownfield site with existing 69 kV power lines, on-site permitted water access with rights secured to 2070, and immediate access to the I-10 highway and Southern Pacific rail lines. This plug-and-play infrastructure significantly reduces the technical and logistical hurdles associated with greenfield developments. The delisting of ASCU and its conversion into a wholly owned subsidiary of Hudbay provides ASCU shareholders with immediate exposure to a diversified operating platform and an NYSE listing, while reducing their exposure to the financing risks of a single asset company.
Operational performance by region, 2025 retrospective. Peru, Constancia, and Pampacancha. The Peru operations delivered a robust performance in the fourth quarter of 2025 as operations normalized after the September disruptions. Copper production reached 25,000 tons in the quarter, with gold production at 33,000 ounces. The highlight of the year was the efficient mining of the Pampacancha satellite deposit, which allowed the company to far exceed the top end of its gold production guidance for the region. However, mining at Pampacancha was completed in late December 2025, and the remaining high-grade stockpiles were processed in early 2026. The shift back to the primary Constancia deposit necessitates the throughput increases planned for the second half of 2026 to maintain production parity. Manitoba, Snow Lake, and Lalor. The Manitoba operations were significantly impacted by mandatory wildfire evacuations in the third quarter of 2025, resulting in a suspension of activities for the majority of that period. Despite this, the region normalized quickly, with the New Britannia mine achieving record performance during the year.
Gold production in Manitoba for 2025 totaled 173,453 ounces, which was slightly below the low end of guidance due to the evacuations and unplanned winter storm power outages in October. Looking forward, Manitoba remains a cash cow for the company, with 2026-2028 guidance projecting an average of 190,000 ounces of gold and 11,500 tons of copper annually. British Columbia, Copper Mountain. The integration of Copper Mountain remains a work in progress. While the facility produced 23,784 tons of copper in 2025, below the guidance range, it met its gold and silver targets. The fourth quarter was particularly challenging, with throughput constrained by reduced mill availability and the processing of lower-grade stockpiles. However, the completion of the SAG-2 conversion project and the ongoing accelerated stripping campaign are designed to deliver a significant production step-up in 2027-2028. The full ownership of the mine allows Hudbay to fully capture the benefits of these optimization efforts without sharing the upside with a minority partner.
Peer group comparison. Hudbay continues to trade at a discount to many of its peers when measured by enterprise value to EBITDA and price to net asset value. London Mining, for instance, trades at a PE of 20.61x compared to Hudbay's 15.05x. London has historically commanded a premium due to its larger market capitalization and its focus on jurisdictions like Chile and Sweden, which are perceived to have lower social risk than Peru. However, Hudbay's 2025 net margin of 25.80% outperformed Capstone Copper's 13.27%, and its ROE of 19.30% was nearly double that of Capstone. If management successfully executes the 2026-2027 production ramp-up in British Columbia and avoids major disruptions in Peru, the market is likely to compress the multiple gap between Hudbay and London. Furthermore, as Copper World moves from the development category to construction and eventually production, the project will begin to be valued on a cash flow basis rather than just a NAV basis.
Conclusion. The bull case is driven by record-breaking gold and copper prices, a peer-leading growth profile through the Arizona Copper District. The Made in America narrative for Copper World and Cactus provides a structural advantage that is likely to attract a critical mineral premium as domestic supply becomes increasingly important to U.S. industrial policy. However, the bear case must be monitored.
The inherent volatility of mining in Peru, the execution risks of multi-billion-dollar construction projects, and the legal opposition in Arizona are significant hurdles. Any major production miss or cost overrun at Copper World would quickly erode the market's confidence in the Hudbay narrative.